Most people interact with it daily without realizing it. Tonight, we explore inside the system that keeps money flowing step by step. Every day, money moves. It flows from one place to another, from employers to workers, from buyers to sellers, from savers to borrowers, from one account to another account. This movement happens constantly, during the day and through the night, on weekdays and weekends, in cities and in rural areas. The flow never completely stops. Most people notice only their own transactions. A payment received, a bill paid, a purchase made. Each person sees their individual movements of money. But beneath these individual movements lies something larger, a system that enables all the movements to occur, a network that connects everyone who uses money, an infrastructure that makes the flowing possible. This system operates mostly invisibly. People use it without thinking about it. They trust it will work when they need it. They rarely consider what makes it function. Yet the system is always there, always operating, always enabling the flows that people depend on. When someone receives a payment, the money must travel from the payer to the receiver. This travel happens through channels that most people never see. The channels carry value from source to destination. The channels exist in multiple forms. Some are physical, some are electronic, some are institutional arrangements. Together they create pathways for money to move. The pathways connect countless participants. Individuals, businesses, governments, and organizations all connect to the system. Each participant can send money to others. Each can receive money from others. The connections form a vast network. The network has no single center. It has no single controller. It operates through distributed cooperation among many participants. This cooperation happens largely automatically. Systems communicate with other systems. Information flows alongside the money flows. Transactions complete without requiring individual oversight of each step. The automation enables speed. Payments that once took days or weeks now occur in moments. The system processes transactions far faster than human handling could achieve. But speed is not the only feature. The system also provides reliability. Payments arrive where they should. Amounts remain accurate. Records are maintained. This reliability requires mechanisms to prevent errors and fraud. Verification processes check that transactions are legitimate. Security measures protect against unauthorized access. Reconciliation procedures ensure accuracy. All these mechanisms operate behind the scenes. They work continuously to maintain the system's integrity. They prevent problems before problems affect users. The system also maintains records. Every transaction leaves a trace. The traces accumulate into histories. The histories show patterns of money movement over time. These records serve multiple purposes. They allow participants to track their own activities. They provide evidence when disputes arise. They enable oversight to detect problems. The record keeping happens at multiple levels. Individual accounts track personal transactions. Institutional records track movements through organizations. System-wide records capture aggregate flows. All this record keeping requires infrastructure. Databases store vast amounts of information. Computing systems process and analyze the data. Communication networks transmit information between locations. The infrastructure has grown tremendously over time. What began as simple ledgers in physical books has evolved into complex digital systems spanning the globe. The evolution reflects changing needs and capabilities. As economies grew, more transactions needed processing. As technology advanced, new methods became possible. The system adapted continuously. Yet certain fundamental features remain constant. Money must flow from sources to destinations. Flows must be recorded accurately. The system must be reliable and secure. These requirements shape everything about how the system operates. Every component exists to serve these functions. Every process supports these goals. The system handles many different types of flows. Large payments and small payments. Domestic transactions and international transactions. Immediate settlements and delayed settlements. Each type of flow may use different pathways. Different mechanisms may apply. But all flows ultimately depend on the same underlying infrastructure. The infrastructure includes institutions that facilitate flows. Banks serve as key nodes in the network. They hold accounts and process transactions. They connect individual users to the broader system. Other institutions also participate. Payment processors handle specific types of transactions. Clearing houses coordinate settlements among multiple parties. Central banks provide foundational services. These various institutions interact continuously. They exchange information about pending transactions. They transfer funds to settle obligations. They coordinate to keep the system functioning. The coordination happens through established protocols. Rules govern how institutions communicate. Standards define message formats and procedures. Agreements specify rights and responsibilities. These protocols developed over time through collective effort. No single entity designed the entire system. It emerged from many contributions and innovations. The result is a system that functions despite complexity. Millions of transactions processed daily without central coordination. The system is resilient because it is distributed. No single point of failure can stop all flows. But the resilience has limits. Problems at major institutions can affect many participants. Technical failures can disrupt service. Security breaches can threaten integrity. Managing these risks requires constant effort. Institutions invest in redundant systems. Backup procedures exist for when primary systems fail. Monitoring detects problems quickly. The system also faces challenges from criminal activity. Fraud attempts occur regularly. Theft is always a risk. Money laundering exploits legitimate channels. Combating these threats requires sophisticated defenses. Transaction monitoring looks for suspicious patterns. Identity verification prevents unauthorized access. Reporting systems alert authorities to potential crimes. These defensive measures add complexity to the system. They slow some transactions to allow security checks. They require users to provide additional information. The trade-off balances security with convenience. Most users accept the trade-off without much thought. They want their money to be safe. They are willing to tolerate some inconvenience. The system provides security they could not achieve alone. The system also provides trust. People trust that money sent will arrive. They trust that balances shown are accurate. They trust the system will be available when needed. This trust is not automatic. It must be earned through reliable performance. It must be maintained through consistent operation. It can be lost if problems occur. Maintaining trust requires transparency about how the system works. Users need to understand basic operations. They need access to their own records. They need ways to resolve problems. The system provides these features through various interfaces. Account statements show transaction histories. Customer service addresses questions and issues. Dispute resolution processes handle errors. These user-facing elements rest on the deeper infrastructure. The infrastructure does the actual work of moving money. The interfaces simply make that work visible and accessible. Understanding the system means looking beneath the interfaces, seeing the layers of mechanism that enable the flows, recognizing the many components working together. The components include technology, institutions, rules, and people. Each plays essential roles. Each depends on the others. Technology provides the tools for processing and transmitting. Institutions provide the organization and coordination. Rules provide the standards and protocols. People provide the judgment and oversight. Together, these components create something greater than any individual part. They create a system that keeps money flowing, a system that enables economic activity, a system that most people use daily without fully understanding. What follows is an exploration of this system, an examination of its components and operations, a look at how it came to be and how it functions. The exploration proceeds step by step. Each step builds on previous understanding. The pace is deliberate to allow comprehension without strain. The system that keeps money flowing is the infrastructure and processes that enable payments to move from payers to receivers. At its core, this system is a network of accounts connected by transfer mechanism. An account is a record of money belonging to someone. The account shows how much money the person has. It tracks money coming in and going out. The balance reflects the current amount available. Accounts exist at various institutions. Banks hold accounts for their customers. Other financial organizations also maintain accounts. Government agencies hold accounts for official purposes. Each account connects to the larger system. Through this connection, money can move between accounts. The movement is what creates the flow. A transfer mechanism is a method for moving money from one account to another. Many transfer mechanisms exist. Each has different characteristics and uses. The simplest transfer happens when both accounts are at the same institution. The institution reduces the balance in one account and increases the balance in another. The total money at the institution stays the same. Only the distribution changes. This internal transfer is straightforward. The institution controls both accounts. No external coordination is needed. The transfer completes quickly. More complex transfers involve accounts at different institutions. The money must somehow move from one institution to another. This requires coordination between institutions. The coordination happens through various channels. Institutions maintain accounts with each other. They also connect through intermediaries that facilitate transfers. Central clearing systems coordinate many institutions simultaneously. When someone initiates a payment to another institution, a message is sent. The message contains details about the transaction. Who is sending? Who is receiving? How much? And when? The receiving institution gets the message. It verifies the information. It credits the receiver's account. It sends confirmation back. Settlement occurs when institutions actually transfer funds among themselves. This often happens in batches rather than transaction by transaction. At day's end, institutions calculate net positions with each other. They transfer funds to settle the net amounts. This batching improves efficiency. Rather than many small transfers, institutions make fewer larger transfers. The approach reduces costs and complexity. But batching means individual transactions settle with delay. A payment made in the morning may not fully settle until evening. The receiver sees the money immediately in their account, but the institutions handle final settlement later. Some transfers settle immediately in real time. These use different mechanisms designed for instant settlement. They cost more but complete faster. The choice of mechanism depends on the payment's purpose. Urgent payments use real-time systems. Routine payments use batch systems. The system offers different options for different needs. The system exists because economies need reliable ways to transfer value. Without such mechanisms, exchange would be difficult. In ancient times, people traded physical objects directly. Barter required finding someone who had what you wanted and wanted what you had. The double coincidence was often hard to achieve. Money solved this problem by providing a common medium of exchange. Rather than trading goods directly, people traded goods for money and money for goods. Money became the intermediary in exchanges. But physical money has limitations. Carrying large amounts is risky and inconvenient. Making distant payments requires physically transporting money. Verifying authenticity can be difficult. These limitations drove development of transfer systems. Rather than moving physical money, the system moves claims to money. Account balances represent claims. Transfers reassign claims from one party to another. This abstraction from physical money to account balances was a crucial innovation. It made money more mobile. It enabled payments across distances without physical transport. It created possibilities for much larger volumes of transactions. The system solves several fundamental problems. It solves the distance problem. Payments can reach anywhere the network extends. Geographic separation no longer prevents transactions. It solves the security problem. Money in accounts is safer than money in pockets. Theft requires breaching security systems rather than simple physical theft. It solves the record-keeping problem. All transactions automatically create records. No separate documentation is needed. The records are comprehensive and permanent. It solves the divisibility problem. Account balances can be divided to tiny fractions. Payments of any size are possible. Physical money has limits on how small denominations can be. It solves the speed problem. Electronic transfers complete in moments. Physical transport took days or weeks. The time compression enables economic activities that depend on quick payment. All these solutions rest on the infrastructure that enables account-based transfers. The infrastructure is what the system fundamentally is. The infrastructure includes the technology that processes transactions. Computer systems at each institution handle internal operations. Communication networks transmit information between institutions. Databases store all the account and transaction data. The infrastructure also includes the institutions themselves. Banks and other financial organizations serve as nodes in the network. They hold accounts and execute transfers. They provide interfaces for users to access the system. The infrastructure further includes the rules and standards that govern operations. Protocols define how institutions communicate. Regulations establish legal frameworks. Contracts specify relationships and responsibilities. The infrastructure finally includes the people who operate and oversee everything. Technical staff maintain the system. Operations staff process transactions. Compliance staff ensure rules are followed. Executives make strategic decisions. All these elements work together to create a functioning system. Each element is necessary. None is sufficient alone. The system that keeps money flowing is thus a complex combination of technology, institutions, rules, and people. It is infrastructure comparable to roads or electrical grids. It enables activities that depend on it but extend far beyond it. Understanding what the system is means recognizing it as essential economic infrastructure. Infrastructure that makes modern economic life possible. Infrastructure that has developed gradually over time. The development of this infrastructure is the next topic to explore. How did the system come to exist in its current form? What innovations and changes led to today's capabilities? The system that keeps money flowing did not appear suddenly. It developed gradually through many incremental changes over long periods. The earliest forms of money transfer were simple and physical. One person handed coins to another person directly. The transfer was immediate and visible. No record existed unless someone wrote it down separately. As trade expanded, the limitations of direct physical transfer became apparent. Merchants traveling long distances faced risks carrying money. Theft was a constant danger. Large transactions required transporting heavy amounts of coins. These problems led to early innovations in transfer mechanisms. Merchants developed letters of credit. A merchant could deposit money at one location and receive a letter. The letter authorized withdrawal of equivalent money at another location. This system required trust between the locations. They had to keep accurate records. They had to honor each other's letters. They had to settle accounts periodically. The letters of credit were early forms of the modern transfer system. They separated the physical money from the claim to money. They enabled value transfer without physical transport. Banking institutions formalized these arrangements. Banks accepted deposits and issued claims. The claims could be transferred to others. Banks built networks with other banks to enable distant transfers. Early bank transfers happened through correspondence. One bank would write to another bank requesting a transfer. The letter traveled by mail or courier. The receiving bank would execute the transfer upon receipt. This process was slow but more secure than transporting coins. It gradually became the preferred method for large payments and distant transactions. The development of checking systems was another major innovation. A check was a written instruction to a bank to transfer money from one account to another. The account holder wrote the check and gave it to the receiver. The receiver presented it to their bank for deposit. Checks became widely used because they were convenient. They eliminated the need for cash in many transactions. They created automatic records of payments. They could be sent through regular mail. But checks also introduced new complexities. Banks needed ways to exchange checks and settle balances. Systems called clearinghouses emerged to facilitate this exchange. Clearinghouses were locations where representatives from multiple banks met regularly. They exchanged checks drawn on each other's institutions. They calculated net amounts owed between banks. They arranged settlement of the net balances. The clearinghouse system enabled checks to work across many banks. It provided the coordination that individual banks could not achieve alone. Telegraph technology brought new possibilities in the late 19th century. Messages could be sent almost instantly over long distances. Banks began using telegraphs to communicate about transfers. Telegraph transfers were much faster than mail. They enabled time-sensitive payments. They supported business activities that required quick fund movement. The telephone extended communication capabilities further. Bank staff could speak directly to coordinate transfers. Verbal confirmation supplemented written documentation. But the real transformation came with computers. Computing technology revolutionized how the system operates. Early computers automated internal bank operations. They processed transactions faster than manual methods. They maintained more accurate records. They reduced errors and labor costs. As computers became more capable, banks connected them together. Computer networks allowed direct machine-to-machine communication. Electronic messages replaced paper-based processes. The shift to electronic processing happened gradually over decades. Each bank had to invest in technology. They had to develop compatible systems. They had to train staff in new methods. Standardization was crucial to making electronic systems work. Banks needed to agree on message formats. They needed common protocols for communication. They needed shared security procedures. Industry associations and regulatory bodies facilitated standardization. They convened banks to develop common approaches. They established specifications that all participants followed. The standardization enabled interoperability. Any bank following the standards could connect to any other bank. The network effect made each connection more valuable. As more banks joined, the system became more useful to everyone. Automated clearinghouses emerged to handle electronic transactions. These were computerized versions of the physical clearinghouses. They processed transactions in batches electronically. Settlement happened through electronic fund transfers. The automation dramatically increased capacity. Millions of transactions could be processed daily. Costs per transaction declined. Speed improved substantially. Different systems developed for different purposes. Some systems handled large value payments between financial institutions. Others processed high volumes of small consumer transactions. Specialized systems served international transfers. The proliferation of systems created its own complexity. Participants had to connect to multiple systems. Each system had different rules and procedures. Integration required ongoing effort. Over time, some consolidation occurred. Smaller systems merged into larger ones. Standards became more uniform. The overall structure became more organized. Central banks played important roles in system development. They often operated key payment systems. They established rules and standards. They provided oversight to ensure stability. The involvement of central banks gave the systems authority and reliability. Participants trusted systems backed by central banks. The backing provided confidence that settlements would occur. International systems required even more coordination. Different countries had different currencies and regulations. Messages needed to cross borders and legal jurisdictions. Currency exchange added complexity to transfers. Organizations formed to facilitate international payments. They created global networks connecting banks in many countries. They developed standards for cross-border messages. They provided infrastructure for currency settlement. These international systems made global commerce practical. Businesses could pay suppliers in other countries reliably. Individuals could send money to family abroad. Trade expanded as payment systems improved. The development of card-based payment systems added new layers. Credit and debit cards provided consumers with convenient payment tools. Merchants accepted cards as alternatives to cash or checks. Card systems required new infrastructure. Card networks connected merchants, banks, and cardholders. Transaction authorization happened in real time. Settlements occurred through the network. Building this infrastructure involved massive investment. Card companies created processing systems. Banks issued cards and installed acceptance equipment at merchants. The infrastructure spread gradually over decades. Mobile technology brought the most recent wave of innovation. Smartphones enabled payment applications. People could initiate transactions from anywhere. Digital wallets stored payment credentials. Mobile payments required adapting existing systems. Traditional infrastructure had to connect to mobile apps. Security needed to work in mobile environments. User interfaces had to be redesigned for small screens. The adaptation continues today. New technologies keep emerging. The system keeps evolving to incorporate them. Throughout all this development, certain patterns repeat. Innovation begins with solving a specific problem. Early adoption is limited to those willing to experiment. Standards emerge through trial and cooperation. Widespread adoption follows once standards stabilize. The process is never finished. Each solution creates new possibilities that lead to new problems. Each innovation builds on previous infrastructure. The system is always in transition from one state to the next. The formation of the system also involved establishing legal frameworks. Laws define what constitutes valid payment. Regulations govern how institutions must operate. Contracts specify relationships between parties. These legal structures developed alongside the technical infrastructure. As new payment methods emerged, laws adapted to address them. Regulations evolved to ensure safety and fairness. The legal frameworks vary by country and jurisdiction. Each place has its own rules and requirements. International payments must navigate multiple legal systems. Harmonization efforts have increased consistency across borders. Treaties and agreements establish common principles. International organizations promote best practices. But significant variation still exists. The formation of the system also required building trust among participants. Banks had to trust each other to honor obligations. Customers had to trust institutions to keep money safe. Merchants had to trust that payments would actually transfer. Trust developed through experience and reputation. Institutions that performed reliably gained trust. Those that failed lost trust and often failed entirely. The surviving institutions were those that maintained reliability. Regulation reinforced trust by setting minimum standards. Regular audits verified compliance. Penalties discouraged misconduct. The regulatory framework provided assurance beyond individual reputation. Insurance and guarantees added another layer of trust. Deposit insurance protected customer accounts. Transaction guarantees protected against fraud. These protections made participation safer. The formation of the system was thus a multidimensional process. Technical development provided capabilities. Institutional development provided organization. Legal development provided framework. Trust development provided foundation. No single entity planned or controlled the entire process. The system emerged from countless decisions and contributions. Each participant acted in their own interest. Collective benefit emerged from individual actions. The result is a system that works despite no central design. It functions through distributed cooperation. It adapts through ongoing evolution. It serves needs that no individual participant could serve alone. Understanding how the system was formed reveals its nature as human creation. It reflects choices made over time. Different choices would have produced different systems. But having been formed, the system now exists as reality that shapes subsequent choices. Current capabilities enable certain activities. Current limitations constrain others. The system both enables and constrains economic activity. With this understanding of formation, attention turns to function. How does the system actually operate day to day? What happens when someone initiates a payment? How do the various components work together to complete transfers? The daily functioning of the system begins when someone decides to make a payment. This decision triggers a sequence of activities across multiple systems and institutions. The payment can be initiated through various interfaces. Someone might write a check. They might use a payment card. They might log into an online banking system. They might use a mobile app. Each interface connects to the underlying payment infrastructure. The interface translates the user's intent into messages the system can process. When a payment instruction is received, verification begins. The system checks that the payer has authority to make the payment. It verifies sufficient funds are available. It validates that the payment details are complete and correct. If any verification fails, the payment is rejected. An error message goes back to the payer. No further processing occurs. If verification succeeds, the payment enters the processing queue. The queue manages the flow of transactions through the system. Payments are processed in order according to priority rules. For payments within a single institution, processing is straightforward. The institution debits the payer's account. It credits the receiver's account. The balances update. Transaction records are created. The entire process happens almost instantaneously. The system executes these internal transfers continuously throughout the day. Thousands or millions of such transfers may occur. For payments between institutions, additional steps occur. A message is prepared describing the transaction. The message contains identifying information for both parties. It specifies the amount to transfer. It includes any additional details needed. The message is transmitted to the appropriate payment system. Different systems handle different types of payments. Large value payments between institutions use specialized systems. Consumer payments often use automated clearinghouse systems. Card payments use card network systems. The payment system receives the message and performs additional validation. It checks that the message format is correct. It verifies that the sender and receiver are valid participants. It applies any rules specific to that payment system. Once validated, the payment system routes the message to the receiver's institution. The receiving institution gets notification of the incoming payment. The receiving institution then processes the payment. It credits the receiver's account. It sends confirmation back through the payment system. The confirmation indicates successful completion. The confirmation returns to the sending institution. The sending institution updates its records to show the payment completed. It may notify the payer of successful transfer. Throughout this process, records are created at multiple points. Each institution records the transaction in its internal system. The payment system records the message flow. These distributed records provide audit trails and enable reconciliation. Reconciliation happens regularly to ensure consistency. Institutions compare their records with payment system records. They verify that sent payments match received payments. They identify and resolve any discrepancies. The reconciliation process catches errors before they cause problems. It ensures that the system remains balanced. It provides confidence that all transactions are properly accounted for. Settlement occurs periodically to finalize the transfers. During the day, institutions track obligations to each other. One institution may owe another for net payments between them. At settlement time, institutions calculate their net positions. They transfer funds through settlement accounts at central banks. These final transfers complete the payment chain. The settlement transfers are the actual movement of money between institutions. The earlier steps were messages and bookkeeping entries. Settlement makes the transfers final and irrevocable. Some systems settle in real time throughout the day. Each payment triggers immediate settlement. Other systems settle in batches at specific times. The choice depends on the system's design and purpose. Real-time settlement provides finality quickly, but it requires institutions to have funds available instantly. It can be more costly to operate. Batch settlement is more efficient for high volumes. It reduces the number of settlement transfers needed, but it means individual payments are not final until batch processing completes. Different approaches serve different needs. Large critical payments often use real-time settlement. Routine consumer payments often use batch settlement. The system offers both options. Throughout the day, monitoring systems track operations. They watch for unusual patterns that might indicate problems. They measure performance against expected standards. They alert operators when intervention is needed. Automated systems handle most situations without human involvement. Routine transactions flow through predefined processes. The systems are designed to be self-operating. Human operators focus on exceptions and problems. When automated processing encounters an issue it cannot resolve, humans investigate. They apply judgment to determine appropriate action. They manually process transactions that require special handling. Security systems operate continuously alongside transaction processing. They analyze transactions for signs of fraud. They check for unauthorized access attempts. They enforce security policies automatically. Suspicious transactions may be flagged for review. They might be delayed while verification occurs. They might be blocked entirely if risk seems too high. The security layer protects both institutions and customers. Customer service functions run parallel to transaction processing. People contact banks with questions about their accounts. They report problems with payments. They request assistance with various issues. Customer service staff access the same systems to investigate issues. They can view transaction histories. They can initiate corrections when errors occurred. They provide the human interface to the technical system. All these activities constitute the normal daily functioning of the payment system. The activities repeat continuously. They occur across thousands of institutions simultaneously. They process millions of transactions. The functioning is mostly routine and unremarkable. Each transaction follows established procedures. The system handles them efficiently and reliably. Yet this routine functioning is what enables economic activity. Businesses depend on receiving payments for goods and services. Workers depend on receiving wages. Suppliers depend on paying for inputs. The flow of payments keeps the economy operating. If the system stopped functioning, economic activity would quickly freeze. Without payment capabilities, transactions could not complete. Modern economic life depends on the reliable operation of the payment system. The reliability comes from redundancy and robustness built into the system. Critical components have backups. Multiple paths exist for routing transactions. The system can continue functioning even when parts fail. But the system does not operate in isolation. It connects with and depends on many other systems. These interactions create additional complexity and dependencies. The system that keeps money flowing interacts extensively with other economic and financial systems. These interactions create a web of dependencies and influences. The most fundamental interaction is with the banking system itself. Banks are both participants in the payment system and providers of broader financial services. The two roles are deeply intertwined. Banks hold customer deposits. These deposits are the funds that flow through the payment system. When payments occur, deposits move between accounts. The payment system is the mechanism for this movement. The availability of payment services makes deposits more valuable. People keep money in banks partly because they can easily make payments from their accounts. If payment services were unavailable, deposits would be less useful. The payment system thus supports the banking system. It provides essential functionality that banks offer customers. The two systems depend on each other. The payment system also interacts with lending activities. When banks make loans, they create deposits. These deposits then flow through the payment system as borrowers spend the funds. Loan repayments flow back through the system to banks. The volume of payments reflects the level of economic activity. More transactions mean more business being conducted. Payment system activity can indicate economic conditions. Central banks monitor payment flows for this reason. Payment data provides real-time insight into economic activity. Changes in payment volumes or patterns can signal shifts in the economy. Central banks also use the payment system to implement monetary policy. They adjust the interest rates they charge for providing liquidity to banks. These rate changes affect payment system activity. They influence how much money flows and where it goes. The payment system transmits monetary policy effects throughout the economy. When central banks tighten or ease policy, the effects flow through payment channels. The system is the infrastructure through which policy operates. Securities markets interact with the payment system through settlement of trades. When someone buys or sells a security, payment must occur. The buyer's payment to the seller flows through the payment system. Securities settlement systems coordinate with payment systems. They ensure that delivery of securities and payment occur simultaneously. This delivery versus payment protects both parties. The coordination between securities and payment systems is complex. Different securities settle at different times. Different payment methods may be used. Systems must synchronize carefully to avoid problems. Foreign exchange markets interact with payment systems when currencies are exchanged. A payment in one currency requires coordination with a payment in another currency. The timing matters greatly because exchange rates fluctuate. Settlement of foreign exchange transactions involves payment systems in multiple countries. Messages must flow between different national systems. Time zones and operating hours add complexity. Special arrangements exist to manage these cross-border flows. The payment system also interacts with government fiscal operations. Governments collect taxes through payment system transfers. They disperse benefits and salaries through the same system. Government transactions represent significant portions of payment flows. Government participation in the payment system affects its design and operation. Systems must accommodate large-value government transactions. They must handle high volumes during tax collection periods. They must provide the security and reliability government operations require. Business operations depend heavily on payment system functioning. Companies receive revenues through the system. They pay suppliers and employees through the system. Their cash management depends on payment capabilities. Supply chains function through coordinated payment flows. As goods move from suppliers to manufacturers to distributors to retailers, payments flow in the opposite direction. The payment system enables this coordination. Just-in-time operations are possible because payments can happen quickly. Businesses do not need to hold large inventory or cash buffers. They can rely on timely payments to support continuous operations. The payment system interacts with employment through wage payments. Most workers receive payment through electronic deposits. The regular flow of wages depends on reliable payment infrastructure. Workers use their wages to make purchases. These spending flows circulate through the economy. The payment system handles the circulation. Retirement and benefit systems depend on payment infrastructure. Regular benefit payments must reach millions of recipients reliably. The system handles these recurring payments automatically. Healthcare systems interact with payment flows through insurance and billing. Insurance payments flow from insurers to providers. Patient payments flow to providers and insurers. The complexity of healthcare financing creates complex payment patterns. Real estate transactions involve large payments through the system. Property purchases require transferring substantial sums. The system must handle these large values securely. Special procedures often apply to real estate payments. The payment system also interacts with tax collection and reporting. Payment records provide information for tax purposes. Institutions report payment data to tax authorities. The reporting helps ensure tax compliance. Legal systems interact with payments through enforcement of obligations. Court judgments may require payments. The payment system provides mechanisms for executing these required transfers. Regulatory systems oversee payment operations to ensure safety and soundness. Regulations establish rules for how payment systems must operate. Supervisors monitor compliance. The regulatory framework shapes system design and operation. Technology systems beyond payment infrastructure support the overall functioning. Internet connectivity enables online and mobile payments. Cloud computing provides flexible infrastructure. Cybersecurity systems protect against threats. These supporting technologies must remain operational for payments to work. Failures in underlying technology can disrupt payment processing. The dependencies create vulnerabilities. Social systems interact with payments through usage patterns and preferences. Cultural attitudes toward cash versus electronic payment vary. Trust in institutions affects willingness to use payment services. Social networks can influence payment method adoption. All these interactions mean the payment system is deeply embedded in broader society and economy. It affects and is affected by many domains. Changes in one area ripple through to others. The interconnection creates both strength and fragility. Multiple connections provide redundancy and alternative paths, but they also create channels for problems to spread. Understanding these interactions reveals the payment system's central role in modern life. It is not peripheral infrastructure, but essential connectivity. Nearly everything economic depends on its functioning. This centrality makes stability crucial. Disruptions to payment systems have widespread effects. Maintaining reliable operation is a constant priority. The system that keeps money flowing is designed for reliable operation under normal conditions. But conditions are not always normal. Sometimes the system faces stress. Stress can arise from various sources. Technical failures can disrupt operations. Cyber attacks can threaten security. Natural disasters can damage physical infrastructure. Economic shocks can create unusual demands. When stress occurs, the system must respond. The response begins with detection. Monitoring systems identify when something is not functioning normally. Alerts notify operators that attention is needed. Operators assess the situation. They determine the nature and scope of the problem. They decide what actions to take. For technical failures, backup systems may be activated. Redundant components take over for failed components. Processing shifts to alternative infrastructure. Service continues with minimal interruption. The redundancy built into the system provides resilience. Critical functions have multiple implementations. If one fails, others can compensate. Complete system failure requires multiple simultaneous problems. For security incidents, defensive measures engage. Suspicious activity is blocked. Affected accounts may be frozen to prevent damage. Investigations begin to understand what occurred. Security incidents can range from individual fraud attempts to large-scale cyber attacks. The response scales with the severity. Minor incidents are handled routinely. Major incidents may require coordinated emergency response. Cyber attacks on payment systems have become increasingly sophisticated. Attackers seek to steal money or disrupt operations. Defending against these threats requires constant vigilance and updating of defenses. The system incorporates multiple layers of security. Authentication verifies identity before allowing access. Encryption protects data in transit and storage. Monitoring detects unusual patterns that might indicate attacks. Isolation limits damage if defenses are breached. Despite these protections, successful attacks occasionally occur. When they do, response procedures activate. The priority is containing damage and restoring normal operation. Investigation follows to learn from the incident. Natural disasters present different challenges. Physical destruction of facilities can interrupt operations. Power outages can disable systems. Communication disruptions can prevent coordination. Geographic redundancy helps manage disaster risk. Critical systems operate from multiple locations. If one location is affected, others continue functioning. Data is replicated across sites to prevent loss. Disaster recovery plans specify procedures for various scenarios. Regular testing ensures the plans work when needed. Backup facilities stand ready to take over operations. The planning cannot eliminate all risk, but can reduce vulnerability. Systems can survive many problems that would have caused complete failure without preparation. Economic stress can strain the payment system in different ways. Financial crises may cause surges in transaction volumes as people move money. Bank failures may require transferring accounts to other institutions. Liquidity shortages may slow settlement processes. During periods of economic stress, the payment system's role becomes even more critical. Maintaining payment flows helps prevent panic. Reliable operations support economic stability. Central banks may provide additional liquidity to the payment system during crises. This ensures that settlement can occur even when normal funding sources are strained. The central bank backstop provides confidence that payments will continue. Regulatory oversight intensifies during stress periods. Supervisors monitor system functioning more closely. They coordinate with institutions to address problems. They may temporarily adjust rules to facilitate continued operation. The goal is maintaining essential payment functions even in difficult conditions. Some services may be degraded. Processing may slow, but core capabilities should remain available. History provides examples of payment systems under extreme stress. During wars, economic collapses, and major disasters, payment systems have faced severe tests. Many have continued functioning despite enormous challenges. The resilience comes from the importance society places on payment capabilities. When other systems fail, people work hard to keep payment systems operating. The infrastructure receives priority in restoration efforts. Lessons from past stress events inform current system design. Each crisis reveals weaknesses that can be addressed. Improvements accumulate over time. Modern systems are more robust than earlier versions. But new vulnerabilities emerge as systems evolve. New technologies introduce new risks. Increasing interconnection creates new failure modes. The challenge of maintaining stability never ends. Stability requires ongoing investment in infrastructure. Systems must be upgraded and maintained. Aging components must be replaced. Capacity must expand with growing demand. The investment is substantial but necessary. Payment system failures have economic costs far exceeding infrastructure expenses. Reliability is worth the price. Stability also requires cooperation among participants. All institutions depend on each other for the system to work. They must coordinate on standards and procedures. They must help each other during problems. Industry associations facilitate this cooperation. They provide forums for addressing common challenges. They coordinate responses to system-wide issues. They promote best practices. Regulation provides another stabilizing force. Minimum standards ensure all participants maintain adequate capabilities. Oversight catches problems before they become severe. Enforcement creates incentives for responsible behavior. The regulatory framework balances safety with innovation. Too much restriction stifles beneficial change. Too little restriction allows dangerous practices. Finding the right balance requires ongoing adjustment. Testing and simulation help prepare for stress scenarios. Institutions conduct drills simulating various problems. They test backup systems and recovery procedures. They identify weaknesses before actual events expose them. System-wide tests involve multiple institutions simultaneously. These exercises verify that coordinated response procedures work. They build relationships among people who would need to work together in actual crises. The testing cannot cover every possibility. Novel situations will always arise. But preparation improves the ability to handle whatever occurs. Communication during stress is crucial. Participants need to know what is happening. They need to understand what actions to take. Clear communication prevents confusion and poor decisions. Communication channels are established in advance. Contact lists are maintained and updated. Protocols specify who should be informed about what. These arrangements ensure information flows when needed. Public communication also matters during major incidents. Users need to understand if services are affected. Transparency builds confidence. Silence during problems creates anxiety. Recovery from stress follows defined procedures. Services are restored in priority order. Critical functions return first. Less essential functions follow as capacity permits. After recovery, investigation and learning occur. What happened is analyzed carefully. What worked well is noted. What failed or performed poorly is identified. Changes are made to prevent recurrence. This cycle of stress, response, recovery, and learning strengthens the system over time. Each incident provides lessons. Each lesson informs improvements. The system becomes more resilient through experience. But perfect stability remains impossible. The complexity and interconnection ensure that new problems will arise. Understanding stress and stability means recognizing both capability and limitation. The system can handle significant challenges, but it cannot handle everything. What makes the system functional is not invulnerability, but adaptive capacity. It responds to problems. It recovers from failures. It learns from difficulties. This adaptive capacity is the foundation of long-term stability. Static systems become brittle and fail catastrophically. Dynamic systems bend and adjust. The payment system has endured because it evolves. With this understanding of how the system handles stress, the full picture is nearly complete. The various aspects have been explored from multiple angles. What remains is to revisit the key concepts once more, allowing them to settle more deeply. The system that keeps money flowing is infrastructure that enables payments to move from payers to receivers. It operates continuously, processing millions of transactions daily. It remains mostly invisible to those who use it. Yet it shapes economic life profoundly. Understanding this system requires recognizing its components and operations. The components include accounts that hold value for participants. They include transfer mechanisms that move value between accounts. They include communication networks that transmit payment information. They include settlement processes that finalize transfers. They include institutions that operate the infrastructure. All these components work together to enable payment flows. The system developed gradually over many generations. Early methods involved physical transfer of money. Limitations of physical transfer drove innovation. Letters of credit separated claims from physical money. Banking systems formalized transfer arrangements. Checks provided convenient payment instruments. Clearinghouses coordinated exchange of checks. Telegraph and telephone enabled faster communication. Computers revolutionized processing capabilities. Electronic networks connected institutions directly. Standardization enabled interoperability. The accumulated innovations created modern capabilities. Daily functioning involves receiving and processing payment instructions. Verification ensures instructions are valid and authorized. Messages transmit payment information between institutions. Receiving institutions credit accounts for incoming payments. Settlement transfers finalize the payments. Records are created and maintained throughout. Reconciliation ensures accuracy and consistency. Monitoring watches for problems requiring attention. Security systems protect against fraud and unauthorized access. All these activities occur routinely and continuously. The routine operation enables economic activity. Businesses receive revenues and make payments. Workers receive wages. Consumers make purchases. The flow of payments supports all economic activity. The payment system does not operate in isolation. It interacts with banking through deposit accounts and services. It connects with central banks that provide liquidity and oversight. It facilitates securities settlement when trades occur. It enables foreign exchange when currencies are exchanged. It handles government fiscal operations for taxes and benefits. It supports business supply chains and cash management. It delivers wages and benefits to workers. These interactions make the payment system central to economic functioning. Changes in payment flows affect many other systems. Problems with payments can disrupt broad areas of activity. The centrality makes reliability crucial. The system can face various forms of stress. Technical failures can disrupt operations. Cyber attacks can threaten security. Natural disasters can damage infrastructure. Economic crises can create unusual demands. When stress occurs, the system responds through established procedures. Backup systems provide redundancy. Security measures contain threats. Disaster recovery plans guide restoration. Central banks provide liquidity support when needed. The response aims to maintain essential functions. Some degradation of service may occur temporarily, but core capabilities should remain available. Recovery follows defined processes. Services return in priority order. Investigation and learning follow recovery. Improvements are made based on lessons learned. The cycle of stress, response, recovery, and learning strengthens the system over time. Perfect stability is not achievable, but adequate stability for reliable operation is achievable most of the time. Understanding all this reveals the payment system as essential infrastructure. Infrastructure that enables modern economic life. Infrastructure that operates continuously and reliably. Infrastructure that most people use without fully understanding. The invisibility allows the system to function efficiently. Users need not understand technical details to make payments. The system handles complexity behind simple interfaces. But the invisibility also means few appreciate what makes it work. The infrastructure requires constant maintenance and operation. Technical staff keep systems running. Operations staff process transactions and handle exceptions. Security staff defend against threats. Regulators oversee to ensure stability. All this ongoing work sustains the payment capabilities people rely on. The system will continue to evolve. New technologies will enable new capabilities. New payment methods will emerge. New challenges will require new solutions. But the fundamental purpose remains constant: to enable reliable transfer of value between parties, to provide the infrastructure for economic exchange, to keep money flowing through the economy. This purpose gives the system its importance. Economic activity depends on payment capabilities. Without reliable payments, modern economies could not function. The system makes possible the complex economic coordination that supports contemporary life. Understanding the system provides insight into economic functioning. It reveals infrastructure that is usually taken for granted. It shows the mechanisms behind everyday financial activities. The understanding need not be complete to be valuable. Grasping basic concepts suffices. Recognizing that systematic processes enable payments. Seeing how accounts and transfers work together. Understanding that institutions cooperate to make the system function. Appreciating that stability requires ongoing effort. These insights illuminate something most people use but rarely consider. The payment system is fundamental infrastructure comparable to roads or utilities. It enables activities that extend far beyond the infrastructure itself. It creates possibilities that would not exist without it. Modern economic life rests on this foundation. The foundation operates quietly, reliably, continuously. It keeps money flowing from sources to destinations. It connects all participants in the economy. It makes exchange and commerce practical at scale. The system represents accumulated human effort over generations. Each innovation built on previous foundations. Each improvement addressed limitations of earlier methods. The result is infrastructure far more capable than what existed in earlier times. Yet the system remains imperfect and evolving. Challenges persist in ensuring access, security, and efficiency. New problems emerge as technology and society change. Ongoing development continues to address these challenges. The payment system is thus both established and changing. It has stable core functions that persist over time. It has evolving implementations that adapt to new conditions. Understanding this duality helps make sense of the system. What stays constant is the need to transfer value reliably. What changes is how that transfer is accomplished. The mechanisms evolve while the purpose remains. This exploration has made the invisible somewhat more visible. The components have been identified and described. The processes have been explained step by step. The interactions and implications have been examined. What emerges is a picture of complex infrastructure serving essential functions. Infrastructure that operates reliably despite complexity. Infrastructure that adapts to stress and recovers from failures. Infrastructure that enables the economic activities people depend on. The system keeps money flowing. From accounts to accounts, from sources to destinations, through networks of institutions and mechanisms, continuously, reliably, invisibly, supporting economic life at every level. This is the system that keeps money flowing.